Hello, everyone, and welcome to the third edition of our LINUS Investment Talk. My name is Matteo Schmidt. As always, I'll be your host today. I'd like to keep the session as interactive as possible, so feel free to ask any questions you might have. Also, during the webcast on the right-hand side, you'll find a little box. Just put them there, and we'll pick them up as they come in, and we'll answer them as they come in. I'm joined today by Maxi Könen, who's our managing director from the investment team, and we'll be speaking about a very interesting topic. I mean, one of the most debated topics of our times. I'm not talking about the current heat wave. It's the base rate hike that the ECB is going to do tomorrow. We're going to be talking about various aspects of it and various questions of it. We're going to be looking at the effect that that's going to have on the real estate sector in general, on the attractiveness of real estate and investments in particular, if we see any structural changes in terms of financing properties at the moment, both as a private investor as well as a professional investor or as a sponsor, so to say. And I'm really happy that I got Maxi to join me today because he's our expert on this topic. So thanks very much for joining, Maxi. Happy to have you here.
Yeah, thanks for having me, Matteo, and welcome to the audience.
So first question. I mean, I kind of already said it. Do you see any impact at all that the base rate hike tomorrow of the ECB is going to have on the real estate sector, on the real estate market?
No, not immediately.
Mm-hmm. So it's all priced in.
Yeah, because most of it has been priced in over the past 7 months already. So because I think we have to distinguish between three kind of interest rates and three durations that come with it. One is talking about the key interest rate, the ECB and Madame Lagarde are responsible for. Mm-hmm. And this is going to get increased or hiked tomorrow. And then secondly, we have the Euribor, which exists with a 3-month, or the most usual in Europe is the 6-month tenor. And the third one is the rather longer swap rate, which we can see on slide 1, which is the benchmark for each and every mortgage loan in Germany. And if we take a look again at page 1 or on this page here, then we can see that over the past 6 months, the 5 and the 10 years, so the longer interest rate swaps, they increased heavily and historically already. So we are coming from a zero rates environment back in 21 until the end of last year, and then the interest rate increased to 2.5% and came down to 2% where it is right now. So we've seen a huge interest rate increase of 2% already for 10 years.
So for the real estate industry, it's basically old news. So you've seen the increase beginning of the year, and now you're leveling off, and that's basically old news.
Looking at the market, not for everyone it's old news.
Yeah.
But I remember, Matteo, that we had that discussion. It was very cold when we discussed it. So it might have been in February or in March when we talked about the steeply increasing interest rates already, and we discussed what might happen if they came up further and further. And now I think it came to the kind of broader attention of everyone involved in the real estate industry, and especially for all the private person that asked for a mortgage financing over the past weeks and months. They have discovered that interest rates came up already that much, because here the 10-year interest rates swap is always the benchmark, and that increased already. And if you looked at the 6-month Euribor, which is then the very short term, that came up from minus 0.5% to plus 0.5% already. Right here, we could see even in the shorter term interest rates an increase that was not that high, but we could see one already. And the key interest rate that is going to get hiked tomorrow is kind of the basis for the 6-month Euribor. So the 6-month Euribor is kind of the aggregation of all the key interest rates over the next 6 months. And then the 10-year swap rate is the aggregation of all the 6-month Euribors over the next 10 years.
So the average of the next 26 months Euribors.
Exactly. 20 times 6 months is 10 years. So, and without going digging too deep into it from a technical perspective, let's just make one example. So what does the 10-year swap mean? Swap is kind of means there's an exchange between two parties. And we, Matteo, we did a trade. So I do offer you for the next 10 years, the fixed rate, which is now at 2%. So over the next 10 years, every 6 months, I'm going to pay you 2%. And I want you to pay me every 6 months the then prevailing 6-month Euribor rate, which is very, very, or rather volatile, but it's floating, and you get it every day. So if we did this deal right now, then I had to pay you 2%, and you had to pay me the now prevailing 6-month Euribor, which is 0.5% more or less. Which means that you're better off, right? Because you're getting 2% from me and you're paying me 0.5%. So net, I'm going to pay you 1.5%.
Yeah.
And so that will continue over the next 10 years, every 6 months. And what you can see here on this slide is the 6-month Euribor forward rate, which means that at any given point in the future, which you can see on the x-axis, the market anticipates the 6-month Euribor at the certain rate that you can see on the y-axis. And if you took the average over the next 10 years of these forward curves, of these forward rates, and discounted them, yes, your average would be 2%. So looking into this graph here means that until, I don't know, summer of 26, there's the break-even point for the 2%. So until this date, I'm going to pay you more than you're going to pay me. And afterwards, you're going to pay me more. But the average, discounted, will be 2%.
And I would only do the trade if I would expect that the rates are going to increase over 2%, or the average will be higher than 2%, because then I'm saving because I fixed the 2%. And you're only going to do the trade if you think the opposite, right? Because that would bring economic value to each of us.
Exactly. And then there are some, I mean, these trades are not going to, are not only done from an investment or from a speculative standpoint, but often from a hedging standpoint.
Of course, yes.
Right. So this means, and what does now, coming back to the steep interest rate development we've seen over the past 6 months, that means that the market anticipated the 6-month Euribor and the rather short-term interest rates to even go up. So when it increased, let's say in March from 0 to 1%, the market anticipated that the 10-year future Euribor rates will be at an average of 1% when the Euribor back then was in negative territory, right? And that's what I mean by saying the key interest hike tomorrow won't have any immediate impact on most of the real estate market. Now let's take a look at where we might see some rather short-term impact. That's more on the commercial side. Why is that? Because most of the private loans, like all of us buying private home, putting a mortgage loan on it, these in Germany are fixed rate loans. So you fix the rate for at least 5, mostly 10, but you can fix them for 15 or 20 years.
30, right? I've seen people fixing the rates for 30 years.
Even 30. And last year, there were some people that didn't want to pay 20 basis points, so 0.2% more per annum to get the next 10 years guaranteed, would have been a better deal instead of only taking 5 or 10 years, right? So on the private loans, the private mortgage loans, you have the fixed rates. So no immediate impact on those. But on the commercial side, you have floating rate loans, which means they are always priced at 6 months Euribor plus a margin you agreed with the bank. And those, as I said, the 6 month Euribor was in negative territory for the past years. Banks always wanted to float at 0%, so you had to pay 0% plus the margin. Now the market turned and we're back into positive territory again. So right now you have to pay 0.5% plus the margin. And if you look at the forward curve again, it says that in a year you have to pay 1% plus the margin. So these commercial loans become more and more expensive, which means that the interest burden you have to take on these loans increases or has increased heavily and is going to increase more and more. And let's wrap this section up with an example. That means, let's say on a 5-year mortgage loan on the commercial side, you had to pay 0 plus the margin. And today you have to pay 1.7 plus the margin % per annum, which means over a 5-year period, you had to pay 1.7% times 5, 8.5% higher interest cost than at the beginning of the year.
Yeah.
And now if we bring this to the business plan of the sponsor, of the borrower of the loan, you have to make 8.5% more proceeds or more revenues only to offset the interest move over the past 6 months.
I mean, at the end of the day, either he pays it from his profit margin, which probably isn't too big to begin with, right? And then, or he sells it for 8.5% more in a market that is already a bit softening and tighter to finance, right? So that's an incredibly difficult scenario, right?
Yeah, definitely.
How would you see the financing environment in general for a buyer at the moment? Is it really attractive or not that attractive at the moment? How's that?
I think it's getting rougher and rougher. I think we have lots of anecdotes from the market where we saw banks stepping away from term sheets they have given to their clients, to the sponsors, and this comes for various reasons. Because, one, the increased interest rates, the increased swap rates, they lead to higher risks for the banks, because the increased interest rates will put pressure on the real estate prices. They might come down, so the volatility is higher, which means that the risk system and the risk scoring of all the banks becomes worse and worse, because risk is always bad for banks. 2 is mortgage loans and other real estate loans have been a key revenue driver for banks in Germany over the past years, which means that they've built a substantial loan book over the past years, which now get under pressure because interest rates increase, puts pressure on the real estate prices, puts pressure on the loans. So the banks do not really have the time to give out new loans. They firstly have to calibrate their existing loan books and see where the market is right now. 3 is they are rather hesitant right now to give out new loans because they are afraid of even higher interest rates. Since we've seen that steep move in a very, very short period of time, they do not want to kind of catch the falling knife if you were an investor and say, hey, it's from 0 to 2% right now. What if it increased to 3 or even 4% now? I'm rather now, I do feel more comfortable in a wait and see mode instead of now really investing and giving out lots of new loans. And the fourth point is a regulatory one. BaFin, like the German authority, wants them to put more equity into each and every loan to cover the higher risks. And this equity is very expensive. So the bank has to ask themselves whether they want to invest that equity into the loan and whether it's worth the risk, or they have to increase the interest or decrease the leverage, which makes both effects make the loan less attractive for the borrower.
I think the last point is really interesting, because if you think about conceptually, inside a bank, you have different business units competing for equity, right? Because you need equity to fund your activities in that unit. And you have different units asking for this and that and this much equity for the next year on the balance sheet. And equity is a scarce resource on the balance sheet of a bank. And if you're the mortgage business and you say, look, I need more equity, but my profits are probably not going to be great over the next year, I don't know if you're going to receive that equity from a business perspective as a banker. If the asset management business says, look, if you give me that equity, I can guarantee you 20% per annum, right? So
exactly.
I think that's really interesting also from a business perspective as a bank, right? Yeah. But how do you guys react as an investment team, right? You're seeing so many different opportunities every month. I mean, you sort of have a bird's view on the market with the dozens of opportunities that you see per month. Do you think it's attractive for us at the moment, or how's life in the investment team?
I think it's the most interesting market environment we've had since LINUS got founded.
Mm-hmm.
What we've done first after we've seen this steep interest rate move, and I think looking at the background of many people in the investment team, many of us have spent time on or in the capital markets already. So they're aware of interest rates and what they, like which benchmarks you have to look at, what's the kind of the link between the various interest rates we've covered, right? And therefore, I feel like we've been one of the first in the market that have discovered these phenomenons and then calibrated our portfolio against that shift in interest rates. So we spent lots of time to first calibrate our portfolio against the, let's say, new now, so like the new world. And then talking about new business, we underwrite in the new market environment. So we do not really take the 2010, 21 transaction comparables or the interest rates or the cap rates for granted, but we adjusted them to the new market environment. And that lets us become even more conservative.
Mm-hmm. So basically a massive haircut on everything. Well, not massive, but significant.
It just, I wouldn't call it a haircut. It's rather an adjustment when we underwrite prices and yields. And then on the other hand, I think the negotiation power towards the sponsor became better and better, because the competition is not 10 banks or 10 alternative debt providers anymore. It's rather 3 to 4 on a deal. And that brings you in a way better position, which means that interest rate sensitivity is not that high anymore, because it's when we negotiate with the sponsor, it's not about the last basis points or the last 0.1% in interest rate. It's more about the general structure that fits the needs of our investors and those of the sponsor. And it's about lots of flexibility in the market environment, because they want to have flexibility to react in these rather choppy, in that rather choppy market. And on the pricing side, just to give you an example, like 6 months ago, we had fixed rate loans for all of our loans, which means we had a fixed interest rates on it. And we had fixed interest rate on it, let's say for a mass loan, it's 9%. And nowadays, we switch it to a floating rate note, which means we price it at Euribor plus 9%, floored at 0. So that means that for us and for our co-investors, you get at least 9%. And if the Euribor is positive, you get 9% plus the positive Euribor, which means you even have an upside on your yield. Or from another perspective, you give the interest rate risk, like the risk that the interest rates might go up, to the sponsor because he then had to pay more.
Yeah. So basically a free optionality that you get more, but you're always floored at a 0 plus X. So exactly. That's almost the minimum amount that you're going to get. That's really interesting. That's really interesting, especially the negotiation part is pretty interesting to see. And also we've got our first two questions, Maxi. So let's cover the first one, which is sort of a trivia question, but I think that's really interesting as well. It's about the part with the floating rate loans for private investors or private mortgages, right? You've said that in Germany, 95% of the market is fixed for 5, 10, 15, whatever years. But there must be some markets in the EU or in the world where floating rate loans are a large share of the market. Where do you see those risks at the moment? Which country is most affected by this?
I think historically it's the Anglo-Saxonian regions. So in Europe, the UK are those that have the highest share of floating rate loans, or rather really, really short-term fixed rate loans. So short-term, I mean 2 to 3 years, which is probably nothing. Talking about like a floating rate loan that fixes every 3 to 6 months. So there are not too many fixings over the period of the fixed rate loans, right? And this, I think this shows the, let's say, sensitivity or even vulnerability of a regional real estate market to interest rate increases. So what we've talked about before, like the rather longer term fixed rates in Germany, they really, really protect us from prices going down too much. Because what does it mean? Like if you, Matteo, bought a flat 1.5, 2 years ago and fixed the rate for 10 years, then you still had 8 years left from today on your mortgage. You don't have to refi, and it won't bring you into a position if you don't lose everything you have in your life and become insolvent just on the asset. It brings you into a position that you don't become a forced seller and had to sell your asset. And if you bring this to the UK and had a floating rate loan or even a 2 years loan, then you can even put an alarm on it and say, hey, in latest 2 years time or in 1.5 years times, there are tons of private households that had to refi their mortgage. And yes, I know real estate prices might go up and up. So we've seen in the UK today that real estate prices came up by 12% year over year. But what if that stopped? So then you had to refi at a stable or probably lower real estate price, and then it becomes even harder for you, or the interest burden increases heavily, so that might force you into selling your home. And if that is the case for multiple households, then we might see some pressure on the real estate prices.
But you're describing more a way of a gentle, slowdown and not really a bubble bursting, which is the second question. Do you see any bubble in the market that's about to burst?
I'm not afraid of a bursting bubble. I'm afraid of a way smaller balloon that loses lots of air. And to put that into numbers like by 15 to 20%, I would say if you just do the math, like the interest burden you had to pay if you refied your flat today compared to 18 months ago, then you come up with an adjustment of 15 to 20%. And right now we're in a territory where there are no market transactions, and that might change in the light of adjusted real estate prices.
Of course, yeah. Next question, something that I find really interesting because it's more of a culture topic, or zeitgeist topic, if you want to put it that way. How do younger people think, especially like even 2 generations younger than we are, so between 15 and 20 perhaps, how do they think about real estate ownership? Is that something that's going to affect prices in the future because demand is slowing down and younger people are less interested in owning things and are more flexible in terms of their lifestyle, are moving constantly and therefore more likely to rent properties instead of owning them? Is that going to affect the property market? I mean, ultimately also something that you rent has an owner, right? So it's always going to be, you always need a balance sheet to own the asset, but is that going to change? Is the mix going to change between private owners and like large companies? How do you feel about that?
I mean, there are some studies that the newer generations become more conservative again, which means that they might not be that flexible anymore.
Return on Biedermeier, so basically.
Exactly. And I think that might result in the need for more privately owned homes. And on the other hand, I mean, this generation is hitting the market or is entering the market at all-time high prices. And if you not only from an absolute standpoint and not only from a yield on annual rent standpoint, but also from an affordability standpoint. If you look at all the biggest cities in Europe, probably Berlin is still on the more attractive end here, but all the other ones, they are very, very unattractive for younger generations to buy a home now at these prices, even in the light of increasing salaries over the past 24 months in a very, very good market. But that is about to change right now. I mean, we see lots of adjustment from tech companies or hiring freezes, layoffs, and so on. And I think that just this generation might be ready to not only enter but hit the market and look for super attractive market opportunities over the next 24 to 36 months to kind of buy on at more attractive levels than we are right now.
And next question is more on kind of, I'd say, a little bit of a buzzword that we've seen over the past 2 or 3 years, like blockchain, right? So everyone's talking about it. It's going to, have huge implications on the real estate industry, and digital ownership of real world assets is kind of the ultimate target of it, right? So, do you see any real world implications at the moment, like real transactions that have anything to do with blockchain? Or is that a use case that is just being built at the moment and just needs a couple more years to fully hit the mainstream market? Of course, you're seeing some minor, mostly relatively small transactions, but to hit the real mainstream market, like a 250 million core office project in central Berlin, right? When's blockchain going to be there?
Do we see them right now? No, not at all. They are irrelevant to the market. Do we see some use cases where they might become relevant? Yes. For example, smart contracts instead of having to go to a notary in Germany. And then I think here the question is how flexible and how digital is like the German bureaucracy when it comes to not having to go to notary to register a land charge or to sign a purchase agreement. Yeah, but I think it might take some time. That blockchain really takes a relevant piece in the real estate market.
Yeah, and I mean the topics that you mentioned are not like world changing; they're more of an efficiency thing, right? It's improving existing processes and making them more efficient and cheaper and more reliable and all that kind of stuff. So yeah, that is pretty much what I'm thinking as well. But it's going to be really interesting to see also from that angle how the market's going to develop in the next years. That brings us to the end of today's session. It's a wrap. Thanks very much, everyone, for attending. If you have any follow-up questions, always feel free to reach out to both of us by email, LinkedIn, whatever. Give us a call. We're always available. And looking forward to seeing you all in our next episode of the LINUS Investment Talk. Thanks very much.
Thank you. Bye-bye.
Bye.